Buy now or wait. With so much information going on in social media and the news, you might be wondering, is the housing market going to crash?
And is it different for multifamily? Ultimately, the question is, should you wait or get in the game now?
Today, we're going to clear away all the clutter so that you can get clarity and get into multifamily investing.
Yeah, so that you know exactly what actions to take or not take. Things are different for homeowners versus investors. So for homeowners, what they can afford on a monthly basis drives what they can buy a house for. Now, what they can afford on a monthly basis is going to be driven by their W-2 and their personal debt.
Investors buy based on a different set of criteria. They're looking for cash flow, cash on cash return, tax benefits, appreciation. So there's really no W-2 driving the prices on what they can afford. So let's dive into what that means for you as an investor.
How much prices will be affected is really going to depend not on a W-2, but on investors' appetite for cash flow. For example, for the past several years, when we're looking at something that's in the small multifamily 2 to 4 unit category, we would expect to be able to get $250 a door. Not that it's just everywhere, but when we analyze deals, we are looking for deals that we can either walk right into $250 a door cash flow, or more likely create $250 a door cash flow from renovating and then refinancing and getting a new loan. But when interest rates are going up, you have to be willing to adjust. So your appetite for cash flow is really going to help you decide, how much am I willing to pay for a deal? So we know, just from being in investing for 2 decades now, during times like this when interest rates are going up, we're probably going to be looking at more like $150 a door cash flow for us to say, yes, we're not going to be breaking even. We're not into that. We want to make sure everything we do does cash flow. But when interest rates go up, the cost of money goes up, cash flow goes down for a little while. That's just the name of the game. With inflation, literally your dollar is losing value every single day. What you can buy tomorrow is going to be slightly less than what you can buy today with the same dollar. But when you put that money into a hard asset that produces cash flow that actually pays you, you're literally hedging against inflation.
A lot of people are talking about inflation, and some of us might be like, oh, what the hell is inflation? Well, if you think about it in the most simplistic terms, right now they're saying inflation is 8%. So if 8% of your dollar, so there's 100 pennies there. I know we're not really excited about pennies, but they do add up, right? If you have 100 pennies and inflation is 8%, well, that's 8 cents off. So now your dollar is only worth 92 cents. You got to do something about that.
Exactly. So if you think of, you have your money sitting there in the bank doing nothing but just going down in value, if you can put that into an asset, even if it's something as small as a duplex, but you have 2 people in there paying you rent every single month, you use that rent to pay your mortgage and to pay the property expenses. What's left over is cash flow. That cash flow now bolsters up that money. And now you've offset the impacts of inflation. And frankly, you're going to be ahead of the game because of things like appreciation and mortgage pay down. Do you know what mortgage pay down is?
Woo!
It's literally, I think, my favorite thing when it comes
sexy.
to investing. Every month that your tenants are paying your rent or paying you rent and you're paying that mortgage, part of the mortgage is the principal, which means every month that principal balance is getting smaller and smaller and smaller. But not from your paycheck or your dollars. It's from the rent that your tenants are paying. So literally they are paying the mortgage off for you. So not only are you hedging inflation and getting your money into something that's producing money for you, you also have someone else buying your future retirement assets on your behalf.
True.
And you're getting cash flow.
Yeah.
I mean, it's a win all the way around.
We really want to know how we can help you best. And if you're out there and you're afraid of inflation or the impacts or high interest rates and you feel like maybe I can't get started, like drop a comment below. We want to respond to you and give you some tips on how you can still get in the game. Because right now, Warren Buffett has a rule, and I was just talking about this. He has a rule. Don't lose money. That's a good rule. Well, you're losing money if you're not in the game of multifamily investing because of inflation and the impacts on your dollar. So we want to get you in the game. So if you're afraid, drop below what you're most afraid of so that we can help you pop out of that.
All right, so remember the whole question was buy now or wait. Obviously, you can see that we're a fan of not waiting and just really adjusting your investing strategy to go along with what's happening in the market. So the question is the housing market going to crash?
If you think about it, supply and demand is always a factor. It's always a factor. And right now, there's not as much supply as there was back in 2007, 2008 when that crash happened. There were millions of homes on the market. There was a lot of supply. Well, now there's very little supply. There's only about 800,000, a little bit over 800,000 in inventory, where back then it was 3 million. But the demand is even higher right now because you've got all these different generations that are coming into the mix. So when you think about that, millennials are coming out. They're coming from, some of them are in their 40s already and have some kids, and now they're trying to upsize into a newer home. Or you have the Gen X people who are out there and just trying to get into their retirement homes. You've got a lot of people out there that are becoming millionaires before they're 55 and retiring. And they're gobbling up all these homes. Did I just say gobble up? Woo! Enough about us Gen S turkeys out there. I think you get the point. There's a lot of demand for households right now. So that means there's not going to be a crash when there's a demand. In fact, it's quite the opposite.
There isn't enough housing to handle the current demand. Even if demand starts to shrink down because of interest rates, we still have a supply issue. Supply is still driving prices.
And when everybody needs somewhere to live, whether they need to buy or rent, when there are more buyers than there are houses, the prices might soften, but there's not really going to be a crash because the demand is still there without the supply. And really, when you think about it, as interest rates go up, what happens is the price on the homes, people can't afford that much anymore. So their purchasing power, or they might not be able to qualify for that loan, and now they really need to rent. So that's why becoming an investor and being an investor is lucrative even during these times of recession. No matter what, people have to have a place to live.
All right, now let's talk about what if you're a fix and flip investor? How do you adjust? Because look, you don't actually need the market to crash to turn your current fix and flip from, yeah, I'm gonna make 40 grand to, wow, I'm gonna make nothing. Or worst case scenario, I just lost $10,000, right? We don't want you to be in that situation. So how do you adjust as a fix and flip investor when you're going into a market like this? Well, first of all, Jen and I stopped doing our fix and flips a couple of years ago because we saw this coming. I really think COVID just delayed the ultimate, because real estate, it's a cycle, it goes up, goes down. It's super predictable. The timing is what you can't exactly predict. We expected this a long time ago, so we stopped fixing and flipping. Ultimately, what we tell our investors who we work with, our students, we're not suggesting you fix and flip right now. And here's why. When you go to put a house back on the market, you're expecting to get a certain amount because that's what you need to get X profit. If you can't get that amount because interest rates are now higher, which means people's purchasing power is lower, which means it's gonna drive the price that people are willing to pay down, you don't wanna be the one selling the house, chasing the market, trying to figure out, oh, how much do I lower it? How much do I lower it? If you're a fix and flip investor and you're going into a deal, well, first of all, proceed with caution. But what you can do to help mitigate that risk is run the numbers on that property as a rental also. Because there is going to be no shortage at all of need for rental houses. People who are no longer able to buy because of the interest rates, they're gonna wanna rent that house. So when you're looking at your fix and flip, evaluate it both ways. So just in case you need to scrap your plan to resell it because the market, like you just can't catch it and you're not gonna make enough of a profit to make sense to sell it, make sure it still works as a rental. That way you have two different exit strategies available to you.
If you liked this video, smash the like button down there for us. Go ahead, smash it. And because you did, here's a free unicorn. And now that you had said unicorn, watch this video right here on our biggest mistakes.
These are our most gut-wrenching but valuable lessons that we've learned over the past 2 decades that might just save you
a lot of money.
See you next week.
Bye.